Living off passive income is possible, but the version you see all over the internet, that money while you sleep, margaritas on the beach forever storyline, that's mostly fiction. True hands-off passive income is fragile, expensive to build, and way slower than most people admit. Most people who never work again quietly keep working. Today, I want to break down what actually works, the math behind living off your investments, the traps of chasing pure cash flow, and the psychology of living without a paycheck. Before we dive into the numbers, stick around for until the end of this video. That's where I'll explain why hitting your freedom number doesn't magically make you feel free. Also, if you appreciate these breakdowns, tap subscribe and hit the like button so this gets pushed out to more people who need a reality check. All right, let's start with what living off passive income actually means. In plain language, it means your assets pay your bills instead of your job paying your bills. You're not trading hours for dollars anymore. To understand how much you actually need, we have to talk about the famous 4% rule. If you invest in a diversified mix of stocks and bonds, you can withdraw about 4% of your portfolio in the first year of retirement, then adjust that dollar amount for inflation each year, and historically, you'd have a high chance of your money lasting 30+ years. Sounds super clean, until you zoom in. The 4% rule isn't a law of physics, it's a probability based on historical data. More recent research has suggested that in certain environments, like when stock market valuations are high and bond yields are low, a safe withdrawal rate might be closer to something like 3 to 4%, not always a full 4. That doesn't sound like a big difference, but watch what happens. Let's say you want $50,000 per year from your investments. At 4%, you need about $1.25 million. At 3.5%, you need about $1.43 million. That's roughly an extra $180,000 you'd have to save just to support the same lifestyle. And remember, this passive income isn't completely passive. You're selling pieces of your portfolio each year. You're betting that what's left will grow faster than you spend it. Here's where people get blindsided. Inflation. If you say, I've got $1 million, I'll just pull out $40,000 every year forever. That sounds stable, but $40,000 today is not the same as $40,000 in 20 years. If inflation averages 3% per year for 2 decades, prices don't go up a little, they almost double. What used to cost you $40,000 might cost closer to $70,000 or $80,000 down the road. So what do you do with all this? If you're building a withdrawal-based plan, the key isn't to obsess over whether 3.7 or 3.9% is correct. The key is flexibility. Maybe you aim for a 3.5 to 4% withdrawal range, but you're willing to dial back spending in bad market years and loosen up again when times are good. If you can live on, say, 3% of your portfolio in a rough patch and 4% when markets are strong, your odds of success go way up. The math says being able to adjust is often more valuable than simply having a bigger number. So far, we've talked about money, but the most powerful variable in this whole equation isn't your return, it's your spending. Financial planners often use a simple framework. Your freedom number equals your annual spending times the inverse of your withdrawal rate. With a 4% withdrawal rate, that's 25 times. At 3.5%, it's about 28 to 29 times. A $20 per month subscription, that's $240 per year. At a 4% withdrawal rate, that's $6,000 invested behind it. A $700 per month car payment, that's $8,400 per year. When you see spending through this lens, luxury doesn't just cost money, it costs years of your life spent earning and investing to support it. One simple way to track your progress without obsessing over net worth is what I'll call your freedom ratio, passive income divided by annual expenses. Example, you spend $40,000 per year, you have $10,000 per year coming in from dividends, rentals, or side projects. Your freedom ratio is 25%. You're a quarter of the way to full coverage. Here's the twist. You don't need to be at 100% to feel the effects. At 30 to 40%, your stress around work changes. At 50%, you can potentially take a lower-paid job you enjoy more because your portfolio covers the rest. You stop working to survive and start working to choose. There's a huge psychological trap here, lifestyle creep. You tell yourself, if I can just hit 500,000, I'll be good. You hit 500,000. Now suddenly your brain says, actually, I'll feel safer at $1 million. You hit $1 million. Okay, but with inflation, kids, travel, maybe $2 million. If your spending keeps rising with your income and investments, you never actually get free. You just upgrade your treadmill. Here's something to keep in mind. Every dollar you don't spend is a double win. It's one more dollar invested and one less dollar your portfolio has to generate later. We need to talk about the one risk that can destroy even a beautifully calculated plan: sequence of returns risk. It sounds technical, but the concept is simple. The order of your investment returns matters as much as the average return. Here's why that's scary. Imagine two retirees. Both have the exact same average return over 30 years, but one gets good years early and bad years later. The other gets bad years early and good years later. They do not end up in the same place. The person who gets bad years right after they quit their job is in danger, even if on paper the average return looks fine. Imagine you retire with $1 million. Year 1, the market drops 20%. Your million becomes $800,000. You still need, say, $40,000 to live, so now you're down to $760,000. Year 2, the market drops another 10%. 10% of 760 is $76,000, so you're down to $684,000. You withdraw again for living expenses. In just a couple of bad years, you've burned through a huge chunk of your portfolio, and you've sold shares when prices were low. Even if the market recovers later, you have less capital left to benefit from that recovery. On a spreadsheet, the average return might look okay. In reality, the timing nearly killed your plan. Now add psychology. Your life savings drops 20 to 30% right after you walk away from your job. You're staring at your account thinking, did I just make the biggest mistake of my life? The natural reaction is to panic, sell everything, go to cash, wait for things to feel safe again. But selling at the bottom is how a temporary downturn becomes a permanent loss. Plenty of retirement plans don't fail because the math was wrong. They failed because the person couldn't emotionally stick to the plan. One common way to reduce this risk is to build a cash cushion when you first quit. The idea: keep 1 to 3 years of living expenses in cash or very short-term bonds. The rest stays invested for growth. If the market tanks in year 1, you do not sell stocks. You live out of your cash buffer. You wait for markets to recover before going back to normal withdrawals. Yes, holding that much cash slightly drags down your long-term return numbers on paper, but in exchange, you get insurance against the worst timing. You're buying the ability to say, I don't need to sell my investments at a 30% discount just to buy groceries. That psychological safety is worth a lot. We've talked about money. Let's talk about what happens when the money works, but you don't. There's a distinction in the financial independence retiring early community between retiring from something and retiring to something. If your only plan is, I just want to never work again and play all day, it usually feels incredible for a few weeks. Then reality hits. A week of sleeping in and going to the beach is amazing. A year of that with no bigger purpose often turns into boredom, restlessness, anxiety, or picking fights online or in your own house just to feel something. Most of us get a lot of structure, social connection, and sense of competence from our work, even if we say we hate it. Take that away overnight, and you don't just free up your time, you create a void. I've seen people hit their numbers and then spiral because they underestimated how much they needed challenge, growth, and a reason to get out of bed. Here's the last piece almost nobody talks about until it's too late. Don't build a portfolio and then hope a good life is waiting at the finish line. Build the life first, then build the portfolio to support it. Ask yourself, what would you actually do with your time if you didn't need a paycheck? Who would you spend your days with? What would you create, learn, teach, or fix? You don't have to wait until some magical net worth to test this. Take a mini retirement or sabbatical if you can. Try a lower pay job but more meaningful once your freedom ratio climbs. Start hobbies that aren't just about spending money, things that use your skills and curiosity. You might discover two things. You don't need as much money as you thought to feel free, and the earlier you start designing your ideal life, the less you'll be tempted to endlessly move the goalpost. At the end of the day, you're not really buying passive income, you're buying autonomy. I want to hear from you in the comments. What's your rough freedom number right now? If this gave you a more realistic view of passive income, hit like so YouTube knows to show it to more people who need this. Thanks for watching, and I'll see you in the next one.